In finance, the pursuit of optimal returns often leads investors down unconventional paths. Traditional investments like stocks and bonds have long dominated portfolios, but alternative investments are gaining traction. These include real estate, commodities, hedge funds, and private equity, offering unique risk and return profiles. Alternatives can enhance returns, mitigate risk, and provide a hedge against inflation, often exhibiting low correlation with traditional markets. The potential for higher returns and diversification benefits makes alternative investments increasingly attractive. The investment landscape is evolving, with investors seeking new opportunities beyond traditional assets. Financial technology and new platforms have democratized access to alternative investments once reserved for institutional investors. Global market interconnectedness heightens the need for diversification, and alternatives offer low correlation to traditional markets. Low interest rates drive investors to seek higher yields in alternatives like real estate, private credit, and infrastructure. These investments provide attractive yields and diversification benefits, appealing to income-seeking investors. Alternative investments offer a vast array of possibilities, from farmland and timberland to collectibles and cryptocurrencies. They provide exposure to sectors and industries not accessible through traditional investments like commodities and real estate. Impact investing aligns portfolios with values, generating positive social or environmental impact alongside financial returns. However, alternatives often lack liquidity and require specialized knowledge. Thorough research and guidance from financial advisors are crucial before venturing into alternatives. Investors are drawn to alternative investments for their potential higher returns. Alternative markets' inefficiency and unique opportunities can generate outsized returns, especially when traditional assets underperform. Venture capital and private equity offer exposure to promising startups and transforming companies. Hedge funds use leverage to amplify returns, though it also increases risk. Careful consideration and risk management are essential when investing in alternatives. Diversification is a fundamental principle in investing, reducing overall portfolio risk. Alternative investments play a crucial role in diversification due to their low correlation with traditional assets. They can act as a buffer against losses when traditional markets decline. Diversifying within alternatives like real estate and commodities enhances risk mitigation. A well-diversified portfolio can preserve capital and provide peace of mind during market turmoil. Beyond returns, alternative investments offer tax efficiency and inflation protection. Real estate and private equity can provide significant tax advantages, impacting after-tax returns. Commodities and real estate perform well during inflationary periods, preserving purchasing power. Tangible assets like commodities rise in price with inflation, acting as a natural hedge. Investing in these assets can protect portfolios from inflation's negative effects. Alternative investments often face liquidity challenges, unlike easily tradable stocks and bonds. Real estate and private equity have complex processes and lock-up periods, limiting quick access to capital. Illiquidity can offer stability and insulation from market volatility. Investors must consider their time horizon and liquidity needs before investing in illiquid assets. Balancing liquidity and potential rewards is crucial in alternative investments. Transparency is key in alternative investments, often operating with higher opacity than public markets. Hedge funds and private equity firms disclose limited information, making risk assessment challenging. Thorough due diligence and reputable investment managers are essential. Independent research and financial advisors provide valuable insights. Informed decisions mitigate risks in alternative investments. Alternative investments often come with higher costs, including management and performance fees. Specialized knowledge is required to navigate real estate, commodities, and private equity. Alternatives can be more volatile than traditional assets, influenced by geopolitical events and market dynamics. Diversifying across different alternatives can mitigate volatility. Aligning portfolio allocation with risk tolerance and investment objectives is essential. Commodities offer a unique avenue for diversification and inflation hedging. They are tangible assets driven by supply and demand forces, unlike stocks and bonds. Economic growth and industrial production influence commodity prices. Agricultural, energy, and metal commodities each have unique dynamics. Investing in commodities provides exposure to essential global resources. Commodity volatility presents both risks and opportunities for investors. Weather events, geopolitical instability, and economic growth shape commodity demand. Speculation amplifies price swings, making commodity markets more volatile. Anticipating market movements can lead to significant gains. Understanding the factors driving commodity prices is crucial for successful investing. Section 3. Strategies for commodity investing. Investors seeking exposure to commodities have several options, each with its own risk and reward profile. Commodity futures contracts offer a more accessible way to participate in commodity markets. ETFs that track commodity indexes offer a more diversified and less risky way to invest. Investors can also gain indirect exposure by investing in companies involved in commodity production. Derivatives, tools for hedging and speculation. Derivatives are powerful instruments for mitigating risk and amplifying returns. They derive value from underlying assets like stocks, bonds, and commodities. Investors can speculate on future price movements without owning the assets. Hedging offsets potential losses in existing investments. A farmer might use futures to lock in wheat prices, protecting against declines. Speculators aim to profit from anticipated price movements. For example, buying call options on gold if expecting a price rise. Options grant the right, but not the obligation, to buy or sell an asset at a predetermined price within a specified period. This flexibility makes options attractive for managing risk or capitalizing on market movements. There are two primary types: call options and put options. Call options give the right to buy, while put options grant the right to sell. Investors use call options when expecting a price rise and put options for a decline. Futures contracts, agreements for the future. Futures contracts are standardized agreements to buy or sell an asset at a predetermined price and date. Unlike options, futures contracts are binding agreements. They hedge against price fluctuations in commodities, currencies, and interest rates. For example, airlines use futures to lock in fuel prices. Daily settlement or marking to market adjusts accounts for gains and losses. This reduces default risk but adds volatility. Futures are highly leveraged, amplifying both profits and losses. Section 1. Venture capital fueling innovation. Venture capital plays a pivotal role in transforming innovative ideas into thriving businesses. VC firms pool funds to invest in promising startups with high growth potential. They bet on disruptive technologies, innovative models, and exceptional teams, providing financial capital, mentorship, and strategic guidance. VC investments are structured as equity stakes, aligning interests. This incentivizes VC firms to actively support their portfolio companies. Section 2. Angel investors, guardians of startups. Angel investors step in as crucial sources of capital and guidance when traditional funding is challenging. They are high net worth individuals investing personal funds in promising startups. Unlike venture capitalists, angel investors operate independently, often investing in companies they have a personal connection with. They bring financial capital, experience, industry knowledge, and valuable networks. Angel investors typically provide seed funding or bridge financing to help startups reach critical milestones. They play a vital role in nurturing startups, providing resources and support to survive and thrive. Navigating the world of early-stage investing. Investing in early-stage companies requires unique skills, a high tolerance for risk, and a long-term horizon. It involves careful due diligence, ongoing monitoring, and understanding startup ecosystems. Evaluate the founding team, market opportunity, and financial projections. Understand the business model, technology, and potential risks. Early-stage investing requires patience and a long-term perspective. It can take years for startups to achieve profitability or an exit event. Be prepared for uncertainty and market volatility. Diversification helps mitigate losses and capture returns. The allure of passion investments. Investing extends beyond stocks and bonds. Arts and collectibles blend passion with portfolios. These assets offer history, craftsmanship, and cultural significance. From classic cars to rare stamps, the variety is vast. The emotional connection is the true allure. Owning history evokes wonder and personal fulfillment. Arts and collectibles can hedge against inflation. While the world of collectibles offers passion and potential profit, it is essential to approach this market with a discerning eye and strategic mindset. The market can be opaque, illiquid, and subject to price volatility. Understanding factors like provenance, condition, rarity, and demand is crucial. Conduct thorough research, consult experts, and develop a keen eye for authenticity. Finding a buyer can take time and patience. Values can fluctuate based on market trends and economic conditions. Focus on high-quality items with a proven track record. Diversifying across different categories can help spread risk. In the realm of alternative investments, hedge funds stand out as sophisticated vehicles for high net worth individuals and institutional investors. These funds employ a wide range of strategies, often involving leverage and complex instruments to generate high returns. Unlike mutual funds, hedge funds operate with more flexibility and autonomy. This allows managers to pursue unconventional approaches like short selling and derivatives trading. Hedge funds aim to generate absolute returns, striving to profit regardless of market conditions. However, this flexibility comes at a cost with high fees and often illiquid investments. Private equity firms play a transformative role in the global economy, investing in and often acquiring companies that are not publicly traded on stock exchanges. These firms raise capital from wealthy individuals, pension funds, and endowments, pooling resources to acquire, improve, and eventually sell companies for a profit. Private equity firms often target companies that are undervalued, underperforming, or ripe for restructuring. They bring not only financial capital, but also operational expertise, strategic guidance, and access to networks to help these companies enhance their operations, expand into new markets, or streamline their businesses. Private equity investments typically involve taking a controlling stake in a company, either through a leveraged buyout, where the acquisition is financed primarily with debt, or through a growth equity investment, where the focus is on providing capital to fuel expansion. The private equity industry has faced criticism for its focus on maximizing profits, sometimes at the expense of employees or long-term business sustainability. However, proponents argue that private equity plays a vital role in fostering innovation, creating jobs, and driving economic growth by providing capital and expertise to companies that might not otherwise have access to these resources. Bricks and mortar, the enduring appeal of real estate. Real estate offers a tangible asset class with potential for income and capital appreciation. Unlike stocks, real estate provides permanence and stability. It caters to the fundamental need for shelter, creating consistent demand. As populations grow, housing demand rises, driving property values. Real estate investments offer cash flow, tax benefits, and diversification. Moreover, real estate serves as a hedge against inflation. Diversifying your portfolio with real estate. Spread investments across different asset classes to reduce risk and enhance returns. Real estate can diversify a portfolio beyond stocks and bonds. Real estate often moves independently of stock market fluctuations. During stock market volatility, real estate can stabilize a portfolio. Real estate offers diversification within the asset class itself. Geographical diversification can further mitigate risk and enhance returns. Understanding real estate investment risks. Real estate investments offer potential for income and diversification, but come with inherent risks. Markets are cyclical, influenced by economic conditions and interest rates. Market risk involves potential declines in property values. Economic downturns can lead to price depreciation. Liquidity risk is significant. Selling can take time. Real estate requires significant capital, often involving leverage. Leverage can amplify returns but also magnifies losses. Embracing the world of alternatives. The world of alternative investments offers a vast and dynamic landscape for those seeking to diversify their portfolios, potentially enhance returns, and gain exposure to unique asset classes. From the tangible allure of real estate and commodities to the sophisticated strategies employed by hedge funds and private equity firms, alternative investments provide a compelling alternative to traditional stocks and bonds. As we've explored throughout this journey, alternative investments come with their own set of risks and rewards. Illiquidity, information gaps, higher costs, and the need for specialized expertise are all factors that investors must carefully consider before venturing into this realm. However, the potential benefits of alternative investments, such as diversification, inflation protection, and access to niche opportunities, cannot be overlooked. By incorporating alternative investments strategically and prudently, investors can potentially enhance their portfolio's risk-adjusted returns and achieve their long-term financial goals. Before diving into alternative investments, thorough research, due diligence, and consultation with qualified financial advisors are paramount. Understanding the intricacies of each asset class, assessing your risk tolerance, and aligning investments with your overall financial objectives are crucial steps toward making informed decisions in this exciting and ever-evolving landscape.